besides a need to have the ability to short sell?
Rates which you get from bank. Rates which you get from bank.
Yeah, so that's a good point. We've assumed here that the rates are the same as in the term structure. Usually the bank wants to make a little bit of profit with you, right? So they offer you lower rates for deposits and higher rates for loans. That's a good point. What else?
Fees.
Yeah, so fees are generally costs associated to the transaction. So maybe the bank is charging you a fixed fee for opening an account. And when you sell this here, you'll have transaction costs in the bond market, right? If it's a marketplace. Yeah. So these are just basically two very simple examples of what we now are going to label as frictions. So frictions are things in the market or properties of the market which might make transactions more difficult or less profitable, basically. Unfortunately, these make also our analysis quite difficult. So that's what we're going to do now, is we're going to basically assume them away. Not because I think it's realistic that there are no transaction costs and kind of that the borrowing and investing rates are not the same. And you will see other arguments here like taxations, right? So we'll for the beginning assume away taxation. You'll actually study this next semester with Ursula Walter if you're interested in that, kind of what the effects of taxation are. It's a little bit difficult to figure out the relationship between risk and taxation. So these things are obviously all there and present in the market. So it's not realistic to assume them away, and I'm not going to claim that that is a realistic assumption. But why do we do that? Well, basically we want to develop some basic relationships and understand the basic mechanisms of the market first in the most simple context. And usually what we do is we look at one problem at a time. We don't do everything at once. So it's a simplified framework for analysis, and we can always make it more complicated later on, right? But we start with the most simple setting. And throughout this class, we were most of the time looking at these perfect markets. And everything that Ursula Walter is discussing with you next semester is basically called an imperfect market. Right? So she's exactly going through the list of these frictions that we define away and tell you what the effect of the friction is going to be. Right? But this is kind of our reference point. Right? So maybe to tie this to a debate that came up after the big financial crisis. So economics in general and finance specifically were criticized for using theories with rational investors, right? Because that's what many theories assume, right? But the question is, if you go to finance professors and ask them, do you believe that investors are rational? I bet the answer that you get is that 100% say no, they're not. Then the question is, why do you put that in a model? Right? So why do you do that? And there's actually one more reason. So first of all, give me a definition of irrationality. What is not rational? Right. I just already gave it away, right? So you would define a model of rationality, and everything that's not consistent with the model would be called irrational. Right? So to define the term irrational, you need to know what rational is. Right? So to know what imperfect is, you need to know what perfect is as a comparison. So that's your benchmark. And again, you start off with something that's simple and make it more complicated later, right? So the assumptions, that's why we usually start off with rational investors and perfect markets to get kind of first insights and then make it more realistic later, right? So it's usually such a statement that to devalue all of economics because we start with rational behavior as a starting point. Is people who don't really stick to the subject quite long, right? So they go to one lecture and then they're disgusted and leave, and they never come back. It's usually sociology students because this is a minor, right? So they don't really are willing to kind of engage for a longer time. Right? So we do have classes that are kind of the beginning and focus on perfect and rational markets, but of course it's not realistic, and you will have the opportunity to study this more realistic stuff in the next classes. So formally, this assumption now will be valid basically throughout the whole class, and this I will kind of tell you otherwise. So this will always be something in the background. We're going to assume that there are no taxation, no transaction costs like brokerage fees, security lending fees. Short selling is feasible and unrestricted. Borrowing is feasible and unrestricted. Everyone else in the market knows the same thing. Also not true, right? Right. So the opposite of this would be asymmetric information. So where you assume that people don't know the same thing. In the corporate context that you study next semester, that will be, for example, the managers who have better knowledge about the firm than the investors, the equity and the debt holders. Right. So how does this difference in information impact decisions and outcomes? Right. And also the fact that there's some things which are just not observable. So if you go in the area of corporate governance, the equity holders would like to pay the managers not only based on their success, actually, because success can also be random. They actually want to pay them based on their effort, right? You always, even if the industry is in a recession, you still want that the manager exerts effort, right? Unfortunately, the effort of the manager is not observable, right? So you have to kind of find a proxy for that. And that's the basic principal agent problem, right? So you don't know what the manager is going to do, so you create a contract and incentives such that you hope that the manager behaves in your best interest. That's a typical problem coming from asymmetric information. Right? And the manager then has the so-called moral hazard, right? They can do things that are beneficial to them but might be detrimental to the shareholders. And there are people who study this. For example, what happens to the stock prices of the company if the manager just plays golf on the golf course, or if the manager uses the private jet of the company, right? So there are actually research studies about that, kind of figuring out when the manager went on the golf course and then see what happened to the share price on that day. And then finally, this is just a minor point, that we basically assume that no one has the market power to manipulate prices. And obviously, again, that's a simplification. Like when Elon Musk says something about Twitter and his wish to take over, he's of course driving prices, right? But we assume kind of investors here, which are sufficiently small, that they basically have to accept the current price, right? And that they can't move it into one direction because of market power. Again, kind of putting in something like a monopoly or market power, negotiation power can be done, and there are theories and models around that, but this will be kind of advanced stuff. So that's a, I guess, simplified framework just to get kind of basic insights and mechanisms and relationships without making it overly convoluted, and we'll make it more difficult later. What's the relationship between perfect markets and arbitrage-free markets? Well, actually, these concepts are unrelated. Well, maybe I should say independent. They're related. So perfect market, these are kind of properties of the markets, right? So are there taxes? Yes, no. Arbitrage-free markets is about a market outcome, about prices that kind of are the result of the market, right? So this here is kind of the basic properties, and the arbitrage is about the results of the market. So totally different concepts. Of course, as we've just argued, if markets are not perfect, then arbitrage might not be feasible. Like, even if you observe price differences, you might not be able to capture them because of transaction costs and so on. There is a relationship. So imperfect market